This is Brooks, and this is my price action trading course. This module is about best trades. When you have a setup that qualifies for a best trade, look for swings. Swing trading should be the foundation of your business, and you should usually be able to find 1 to 3 swing trades a day on a 5-minute chart. By swing trade, I mean a trade where the reward is at least 2 times the risk. And in general, that means that you're expecting at least 2 legs. Don't force a trade. If it's not good enough, just wait. Eventually there'll be a trade that you feel is good enough. Any time of the day, you can find good trades. I have modules on swing trading in the opening range, in the middle of the day, and into the close. Just about any kind of trade can be a best trade, depending on circumstances. The best of the best probably are major trend reversals. Other very good trades are trading range reversals, breakouts, and pullbacks. First, I'm going to talk about major trend reversal, and you can refer back to the modules on major trend reversals. This is the single best setup for beginners and for experts as well. That's because the reward is usually, well, it's always at least 2 times greater than the risk. Time is on your side, and I think that's very important. Frequency, you usually get at least 1 a day, and the setups require less thinking, and that allows you to rely more on your rules as you manage the trade. Time is on your side. You usually can anticipate many bars in advance before the setup forms. Once you see the trend line break, that usually have 5 to 10 bars to wait to see if the market gives you a major trend reversal setup that looks good enough. You also have time to think about your trade. Is the signal bar good? Is the test sufficiently weak so that it's likely to fail? And once you're into the trade, you can manage with just a few simple rules. Disadvantages: the probability of making a big reward is often only about 40%. 60% of the time you're making small losers and small winners, so you're basically churning and not making any profit. You're also not really losing anything. It's also difficult not to exit when there's a breakout test, as there often is. Remember, all tops are variations of double tops, and that includes major trend reversal tops. A higher high and a lower high major trend reversal are just double tops where the highs don't match perfectly. All bottoms are variations of double bottoms. A lower low major trend reversal, a higher low major trend reversal, a double bottom major trend reversal. They're all variations of the same underlying fundamental process. There's a trend, the market bounces, the market comes down and tests the trend, and sometimes the test, most of the time the test is not exactly at the same level as the first push down. First thing to do, you find a trend, and then you wait for a break of the trend line. And the stronger the break of the trend line, the more likely it will result in a trend reversal. Next, you allow the trend to resume, and you'd like to see the resumption of the trend be substantially weaker than the original trend. Finally, you look for a signal bar, a reversal bar, in the general area of the prior trend's extreme, and that is the complete setup for the reversal. For an example, a higher high major trend reversal, a top, you wait until you see a bull trend, and then you wait for a break below the bottom of the channel, in other words below the bull trend line. Preferably you'll see a test of the moving average. Preferably the break will be strong enough to get to the moving average, but that's not always the case. Next, you'd like to see a rally that tests the high. Since this is a higher high major trend reversal, we're talking about a test going above the old high. And the rally preferably has a lot of selling pressure in it to increase the chances that the bears will be able to reverse the market once it gets up in the area of the prior high. And finally, you need the signal bar, which includes a bear reversal bar preferably. The stronger the signal, the more likely the trade will be successful. Here's an example of a major trend reversal top. In this case, a higher high major trend reversal, and it's on Petrobras, the daily chart. The market was in a bull trend, and it had a break of the bottom of the channel, a break below the bottom of the trend line, and there were many bear bars within the trend line break, so that's good for the possibility of a major trend reversal. And then it eventually went up to a wedge top. Arguably, this is too far above the prior high to call it a major trend reversal. On a higher time frame chart, it probably is, maybe on a weekly chart. So this is a combination of a major trend reversal and a wedge top, which is a fairly common combination. Usually the wedge does not extend this far above the prior high, but sometimes it does. Well, anyway, we're making a higher high. We have a trend line, a trend channel line, overshoot and reversal, and then a strong bear reversal bar. So that is an excellent signal bar. The context is good, and the sell is one tick below the low of the signal bar. You would have been filled on the open. And this is what followed. In general, I look to take profits, partial profits, around twice either the initial risk or the actual risk. The actual risk here is tiny. You sold on the open of the bar, and the actual risk was only a tick above the high of the bar. So to me, that is not helpful in terms of calculating a profit target. I would base the profit target on the initial risk, the height of the signal bar, and try to take part off at 2 times the initial risk, 2 times the height of the signal bar. You could take partial or full profits here. The market's setting up a high 2 buy. There's a high 1 and went above the prior bar, a good bull reversal bar, and the market went above it, even though it turned down. To me, I would take full or partial profits here, a high 2 at the moving average. It's still a bull trend. It's still making higher highs and higher lows. After a wedge, the market normally has 2 legs down. That means it has 1 leg down, and then a bounce, and then a second leg down. This is also arguably a wedge bull flag. 1 push down here, and then 2 and 3. So to me, this is a reasonable buy signal. And that's, I personally would not buy it, but it's strong enough for me to take full or partial profits on a short. I need a stronger signal when it comes to entering a trade than I need to exit a trade. And this is what followed. The market rallied, and again forming a wedge. Major trend reversals often have wedges as part of the pattern. And so now we have 3 pushes up. This bull bar to the top of that bear bar is 1, 2, and 3. Did not quite reach the trend channel line, but we have a decent bear bar and we have good selling pressure. And this rally is significantly weaker than this rally. So the test of the old high is a weaker test. And that's what you want to see. You want to see the bulls weaker on the second time up. Again, bear reversal bar. Place a limit order, place a stop order to sell 1 tick below its low, and you would have been filled on the open. And this is what followed, assuming you held. Most of the time, you take part off at 2 times your risk. You might swing part. Occasionally, you might get out along the way and then look to get back in. Or if you took partial profits at every subsequent signal, you may put your scalp half back on and then again try to take partial profits on that as the market continues your way. In this case, we have 3 pushes down. I don't have a trend channel line drawn, but this fell below the trend channel line and reversed up. Not a good signal bar, so I'd probably stay short. However, when we came down again and had 2 bull bars, we had 2 bull bars here. We're starting to accumulate buying pressure, and we have a bull bar closing on its high tick. I think it's reasonable to exit on a stop at 1 tick above the high of this bar. You would have been filled on that open. Personally, I probably would have exited going into the close of this bar, thinking that the market almost certainly would trade above its high on the next day. The market might be evolving into a trading range when I see this type of price action, and ultimately that's what it did. If you continue to swing, or if you put your short back on at the low 2 at the moving average, you'd probably again get out down here. A bull reversal bar, a micro double bottom, and the bottom of a channel, and a lower low major trend reversal. I don't have the trend line drawn in, but there's a bear trend, a trend line break that went on for about 10 bars, and then a lower momentum test of the bear low. This sell-off is weaker than this sell-off, so that is good for the bulls. The bears are getting weaker, the bulls are getting stronger. So in fact, you could buy here and go long, or you could simply buy to buy back your shorts. Here's another example of both a higher high and a lower high major trend reversal. This is a Nike, an obviously strong bull trend, very tight channel, and a very big bear breakout below the bottom of the channel, below the bottom of the trend line, and below the moving average. And then a second very strong bear bar, and a third very strong bear bar. 3 pushes down, could be a triangle or a bull flag, and we ended up getting a very sharp rally to a higher high, a new high. But there was this bear bar along the way. So this bear bar might be a 1 bar final flag. This is a tight trading range, and it could be a final flag, a magnet that pulls the market back into it. And then we have the best looking bull bar of the past 50 bars, 60 bars. So it could very well be an exhaustion gap, a buy climax in the end of the move. A small reversal bar, bear body. I would short 1 tick below its low, get filled here. The market sold off a bit. I would not take profits until the market was at least below the moving average. So if 2 times my initial risk was right around here, I would want to hold until at least we get to the bottom of the trading range. Then the market made a 2-legged move up, 1, 2, a bull signal bar, not a great short. You could short below its low, or you could short below the low of this bear bar, and it's a lower high major trend reversal. Usually when you have higher high major trend reversals, they're followed by lower high major trend reversals. At this point we're in a trading range, but we're also in a bear trend. We're forming lower lows and lower highs. So both a trading range and a bear trend, but we're on the major trend reversal sell signal from above and from the lower high. So this would be another opportunity to short another lower high after a lower low. We're starting to trend down. Here we have both tops and bottoms. We have a very tight bull channel on the left, a 2-legged move down with a gap bar, a high below the moving average. When you have a bull trend and a gap bar, that gap bar often leads to the final leg of the bull trend. And here we had a rally, the best looking bull bar of the entire move. So it could be an exhaustion gap, an exhaustive buy climax. I would not sell below that bull bar. This is good for the bears, some selling pressure. And then a small weak rally, small bull bars. To me, I would take this second entry short. We broke out above the prior high. We had a first signal. We routed it a little bit more and have a second signal. I would either short below that little inside bar or below this bear bar. And it sold off into the close. This is the E-mini 5-minute chart. Big gap down, bear channel. The bear channel is a bear trend. We had a rally for about 10 bars. It formed a double top bear flag, but it broke the trend line and it broke the moving average. Gap bars, low above the moving average. Although you cannot really tell from this chart, this is also a gap bar, low above the moving average, so it might lead to the final leg of the bear trend. And here we had a sell-off with very small bars and some bull bodies along the way, and no consecutive big bear bars, so not a very strong sell-off. And then we have a bull reversal bar. So this is a good setup for a lower low major trend reversal. First target, I would not do 2 times risk, because that would only take us up here, and it's likely that we'll get at least up here. So I would not look to take profits until we got at least to the tops of this prior lower high. Okay, a lower low major trend reversal, and then a higher low major trend reversal. Bear trend, break of the trend line, held above the channel for about 10 bars or so, tested the moving average, tails, so failing at the moving average, and then a very sharp bear plunge, very big bars. it's either the start of a new, stronger leg down, or it's an exhaustive sell climax. I did not draw in different resistance support levels down here, but this is at some support level. Every reversal takes place at support levels, and if I showed more of the bars to the left, I'm sure I could find an obvious support level here, but that's not my point with this particular module. So anyway, two big legs down on the open, so it could be an opening reversal, sell climax, very strong sell climax, and a bull signal bar. So to me that's a buy, one tick above its high with a stop below its low. This is Apple. You could put your stop below the low of this entry bar since it's so strong, but a lot of times you get a pullback before the market starts up, so I would keep my stop below the signal bar. Not a very strong rally, but then the sell-off was not very strong either. So right now, after the lower low major trend reversal, we have a higher low major trend reversal. To me, I would not buy this. Too many bear bars and a bear signal bar. I would wait. Then we came down again, so now we have three pushes down. 1, 2, 3. So we have a triangle, but we also have a low, a higher low, another higher low. You can call this a double bottom if you want, or you can call it a series of higher lows. We're in a trading range. We're in a bear trend, and we haven't gone above a significant lower high, but we're also in a bull trend. We're getting higher lows. A triangle is usually both a bear trend and a bull trend, and they're fighting it out. One side ultimately wins. To me, this is a decent signal bar, so I would buy above its high for at least a second leg up. Maybe a leg 1 equals leg 2 move up. Here's leg 1. This is probably the start of leg 2. Strong bull spike, I would not be taking profits yet, because this is a breakout, and we're probably going to get a measured move up, at least based on the height of the spike. Next, trading range reversals. They also can be best trades. You can see the modules on trading ranges and on trading inside of trading ranges. Whenever there's a trading range, I'm looking to buy low, sell high, and scalp. But I always try to get a reward at least as big as my risk. Which risk, actual or initial? Usually, in a trading range, usually the actual risk. If the probability looks high on the setup, I'll go for one-time risk. If the probability looks low or unclear, I usually try to go for 2 times the risk. So if you look at the setup and say, yeah, that looks pretty good, then it probably will not go very far, and I go for one time my risk. If you look at the setup and say, I don't know if that works or not, that tells you lower probability, so you should go for a bigger reward. First thing you have to do is make sure that there is a trading range and not a trend. Very often there are trends within trading ranges, and very often a trading range will break out, and the breakout leg, the trend leg, will start within the trading range. So you have to be looking for that. If the range is big, trade for a swing. If there's enough room for a swing, go for a swing. If the range is small, trade for a scalp. But when you're trading for a scalp, you need a high probability setup. Trading ranges very often have wedge reversals. You can get a wedge reversal near the low, and you can buy that, and you can sell a wedge reversal near the top. For example, clearly a trading range, okay? And now we're forming a wedge bottom, and we have a bull II pattern. To me, that's a good buy for 2 legs up. We got the 2 legs up, and at that point, I would be taking profits or looking for shorts. Signal bar is so small, I would go for more than 2 times the risk. Here we get 2 very strong bull bars, and then a bear bar for a low 2 short, 2 legs up in a trading range. It's also a wedge top. To me, I would not take this short. We're starting a new breakout. Yes, trading range, but I think this, rather than being a failed breakout, will be followed by a breakout pullback buy, which we got here. You could take that for a swing. I would not. I think we're in a trading range, and buying near the top for any reason is usually not a good thing. I would wait to see if in fact it turns into a strong breakout. Trading ranges always race to the bottom and race to the top, and then to the bottom, and then to the top, and then to the bottom, always looking like they're going to break out, but 80% of the time they do not. Here we have a second entry short near the top of the trading range with a bear bar closing on its low. I think that is a reasonable short. Trading ranges often have small final flags near the top and bottom, and if you have a final flag near the bottom and it breaks out to the downside and reverses up, you can buy the reversal. And if you have a final flag near the top that breaks out of the top and reverses down, you can sell that final flag reversal. Here we have a big gap down, but then trading range behavior for the first several bars, first 5 or 10 bars, all the way down. Lots of two-sided trading, lots of buying pressure along the way. Yes, bear trend because it's in a bear channel, but very weak, and it probably will evolve into a trading range. The market's certainly in a trading range by this point, right? Here we have a bear flag, a low two short, one push down, a second push down, but it's at the bottom of an area that I think has a lot of two-sided trading and probably will evolve into a trading range. This is a bear trend, but it looks more like it will be a bear leg and a trading range than it does a bear trend. So I think we're going to be in a trading range today. So I'm looking for reasons to buy. Low twos often become final flags, and especially in trends that have gone on for a while. We have two pushes up here and here, so this is a low two short. I would not take the short. In fact, if I were trading this, I probably would buy with a limit order at the low of this bar, betting that the low two would fail. If I did not buy, I would simply buy one tick above the high of this strong bull reversal bar, looking for a test up to the top of the range. When we get up there, this is a possible double top bear flag, moving average gap bars, so this could result in a test of the low where the market might set up a major trend reversal, which in fact it did. Bear trend, trend line break, gap bars often leads to the final leg, and then a lower low major trend reversal. In any case, we have a wedge bull flag, 3 pushes down, down, up, down, up, down. So 3 pushes down after a bull leg. Wedge bull flag possibly near the top of a trading range, so it could be the final flag. We have the bull breakout and then a 2-bar reversal with a bear bar closing on its low. I think that's a reasonable second entry short near the likely top of a developing trading range. So we place a stop order to go short 1 tick below its low. Reversal up from the new low. First, wait for a breakout below a swing low, and then buy a reversal up. Ranges are always forming failed breakouts. They're always breaking below support and then reversing up. They're always breaking above resistance and reversing down. So for example, you can wait for a breakout above a prior swing high, and then if there's a reversal setup, sell the reversal. Here's an example. Intense trading range behavior for the first 10 bars, probably going to be a trading range day. Big down for a bear spike, big up, 3 bear bars, more up, 3 bars, bear bar. This looks like a trading range. The market fell below this low, and what did it do? A few bars later, it reversed up and went up for a couple of legs. It went above this high and above this high. What do I think it's probably going to do, given all the trading range behavior that we've had? It probably will be a failed breakout and then sell off. So we have a bear signal bar, 2 legs up. Trading ranges often make 2-legged moves and reverse. So we got 2 legs down, 1, 2, 2 legs up, 1, 2, 2 legs down, 1, 2. Trading ranges are always making 2-legged moves, 1, 2. They're always much clearer at the end of the day, but you have to be aware of it during the day because they provide trading opportunities. You look for the second leg to lead to a reversal rather than a breakout. So we broke out above this high and we're reversing down with a decent signal bar. That's a short. We broke out below this low, so you expect it to fail and reverse up. 2 very, very big bear bars, 2 more bear bars. I probably would not buy this reversal, I would wait for a second entry. And here we have a second entry with an II pattern, often leads to a reversal, and a bull signal bar. So this is a reasonable long. You can also argue that it's a wedge bottom, 1 push down here, 2 there, and 3. Market probably went always in long with these 4 bull bars. When it broke above this high, you have to be looking for a reversal. Reversal down here, but 2 very strong bull bars. Might be okay to wait for a second entry. Also, we're not quite up to the top of the range, so we may go a little higher. I would not buy here. We're in the top half of the range. Trading range, you buy low, sell high. You don't buy high. And this is high. You should be looking to sell. We have a second entry short. We broke above this high and are reversing down. So that's a reasonable short. Here we broke below this low. So I'm going to look to buy. This signal bar is small compared to this 4-bar bear spike. I would wait for a second entry. Also, we might get lower down into the trading range. Here we got a double bottom, and it would be a second entry. A bear body, not what you'd like to see, but a trading range day, this is sometimes all you get. We have a 1-bar final flag, reversal up. I would buy above that for a scalp, and maybe buy above that for a scalp as well. Second signals in trading ranges. You wait for a test of the top or the bottom, and then enter on the second reversal. This is an example. This is a good example. Strong push up, not quite to the top of the range, so it's not clear that this is the top. And then we have a second signal here, and the second signal is a strong bear bar closing on its low. So that's a higher probability sell setup. Here we have a first signal, right? But the 4 bear bars and the small bear signal bar, I would wait for a second signal, and we got it here. Here, a bear signal bar, after 4 bars down, I could see not taking this long. In fact, I probably would not, even though we're reversing up below that low, and I would look for a second signal. And here we got a strong bull breakout, probably we'll get a second leg up. We have a second signal, also bear bar, but now it's after a very strong bull bar, so there's a higher chance of a rally. Breakouts. Breakouts are one of my favorite setups. I like major trend reversals the best. I like breakouts the second, pullbacks the third, trading range reversals the fourth. You can take a look at the module on breakouts and then how to trade strong bull breakouts and strong bear breakouts. A breakout of what? A breakout of anything, as long as it's strong. As soon as I see a strong breakout, and I feel like it's probably going to be successful, I want to enter a trade. If the breakout, let's say it's a bull breakout and it's very big, I at least put a small position on. My stop has to be way down below the bottom of the spike, and if that's far away, I'm risking more, so I have to trade small. And you can use any type of order to get in. You can use a market order, a limit order, a stop order. It doesn't matter. If you're seeing a strong breakout and you're looking at it and thinking, gosh, I hope it has a pullback soon, that means you have to get in, because that means it's not going to have a pullback soon. If everybody's waiting for a pullback, it's never going to happen, because everyone will be starting to trade small relentlessly as the trend continues, and the pullback won't come until people are willing to take profits. And if you're right at the start of a breakout, people are just, let's say a bull breakout, people are just starting to get long. Nobody's taking profits. People are just starting to get long. So you don't get a pullback until people take profits. So you may have to wait a long, long time, and you'll end up missing the best part of the trade. What's the easiest entry? At the close of any strong trend bar. Once you're convinced that the market is breaking out, simply enter at the market. As soon as the bar closes, enter at the market. Or place a limit order to get in at the close of that big trend bar. The advantages of the breakouts: the probability is high, and the reward is high. You'll usually get a measured move based on the height of the trading range that preceded it, or based on the height of the spike in the breakout. As the spike grows, the measured move target grows, so the profit potential grows. Disadvantage: the risk is big. Remember, if you're going to have a high probability of making a big profit, you have to have a high risk to it. because otherwise it would be a perfect trade and no institution would take the other side of the trade. So if you have a big bear spike and the market is just plummeting down, your stop goes above the top of the spike, right? So your risk is very big. You have a high probability of making a profit and your reward is good. It probably will be a measured move based on the height of the spike, but it comes at the price of a big risk. You could get a big pullback before the market ultimately reaches your target. So you have to trade small. And also it's difficult emotionally. The risk is big, and that's upsetting. Oh, you say, wait a minute, this is very different from what I'm used to doing. I have to process this emotionally. That can be scary and stressful. You have to change your defaults. With the risk big, you have to trade smaller, so you can't just rely on your usual position size, your usual profit target, and your usual protective stop. You have to make decisions, and with the market moving quickly, it often feels like there's not enough time to make the decisions, so it feels unsafe. But just trade small enough. You got to get down into your comfort zone. You got to get down to the I don't care position size. You got to trade small enough so you really don't care if you lose. You can say, well, Al, if I trade that small, I won't make any money. You will make money, but you won't make a lot of money. However, making some money is better than making no money. And with practice, you can increase your position sizes, and then you can make some very good money. Breakouts, often not enough time to make management decisions. What decisions? Whether I should enter. Should I enter now or should I wait? How far away should my stop be? Wow, that spike is so big. Maybe I shouldn't put it all the way to the bottom. Maybe I should put it halfway down, or maybe I should look for some other reason to use a smaller stop. Position size, oh wow, I'm trading with a much bigger stop. I got to reduce my position size. Profit target, oh, my risk is bigger. I can't go for a small profit. I have to adjust that as well. Remember, a spike is a breakout. The same, they're just two words that mean the same thing. Strong bull trend also means the same thing. I use the terms interchangeably. Whenever I'm talking about a strong bull trend, I'm talking about a bull breakout and I'm talking about a bull spike. They're all the same. As soon as you see it and you say, wow, this looks really good, I can't wait for a pullback, get long. You buy at the market. You buy at the close of any strong bull bar. If the market has a strong bear bar, buy that close as well, because that's an attempt by the bears to make the breakout fail, and 80% of breakout failures don't succeed, and they result in pullbacks. You buy above the high of the prior bar. You buy below the low of the prior bar. If the market falls below the low of the prior bar, it's trying to reverse, okay? And the reversal attempt will probably fail. 80% chance it'll just become a bull flag. So just buy at the low of the prior bar, because probably it'll reverse back up on the next bar, and if you buy above the high of the next bar, your entry price will be worse. You press bets when the trend is very strong. The market makes a high, it pulls back. You can buy the breakout of the pullback, and you can also buy it when it goes above the prior swing high. And you have to decide early. All right, we have a gap up and a high 2 from yesterday's close, and we have an opening reversal. We had a little push up and then a pullback near the moving average with a very strong bull bar, another okay bull bar, and then we have this bar closing on its high. Okay, the range so far is small, less than half of an average daily range, so the range will probably at least double. And here we're getting a breakout to a new high with a bar closing on its high. You look at that and you say, I think that's going higher. You buy the close, right? But my stop has to be way down here. I don't want to risk 5 points. Don't trade half size, trade a third size, but buy the close. Another bull bar, buy the close. Another bull bar, buy the close. And you're saying, well, Al, I don't want my stop way down here. That's where your stop goes. Or you could put it below the low of this breakout bar. You could also put it below this bar as well. But the tighter the stop, the more likely you'll get stopped out. You don't have to buy every close, right? You can buy this close and scalp out part, put the scalp back on here, scalp out part, put the scalp back on here if you want. The swing part, though, your stop is either down here or down here. So this is that same chart. You buy closes, right? That's a good way to trade strong trends. You buy bear closes as well, because they're attempts to reverse the market, and they're probably going to fail. But you use the appropriate stop, below the bottom of the spike, below the bottom of the beginning of the strong breakout phase. You buy above the high of the prior bar, right? Again, for a swing, your stop is down here. So it doesn't matter if you buy this high, right? Your stop is down here. And you say, well, I don't want to risk that many points. Fine, trade really small. Trade 1/4 your normal size, but that's what you do. You don't have to take every signal, but you got to take some signal. You got to figure out how to get long some way, and these are all reasonable ways to get long. You can buy as the market falls below the low of the prior bar, betting that the breakout attempt will fail, all right? Pullbacks. Once the market completes the breakout phase, it enters the channel phase, and the channel phase begins with pullbacks. So once the market is starting to have pullbacks, the trend is changing from a strong trend, the breakout phase, into a weak trend, the channel phase, and there'll be pullbacks, and they offer great opportunities on profit. You can take a look at the module on pullbacks. Pullbacks can be traded for swings in strong trends, and scalps in weak trends and in trading ranges. Whenever you're in a strong trend, or a strong channel, you should always be looking for to swing at least part of your trade. In the strongest bulls, you can buy a high one pullback. For example, during the initial spike up, there may be a pullback for one bar. Buy above the high of that bar. Buy the high one, because that's a reliable buy. Once the trend begins to weaken and starts to have bigger pullbacks, more complex pullbacks, it's transitioning into a channel, a bull channel, in which case you buy high two pullbacks, or triangles, or wedge bull flags. Here's an example of a strong bull trend, a big gap up, and right from the open of the day, we broke to the upside. So this is a trend from the open bull, and we have about 7 or 8 or 9 bar bull micro channel, no pullbacks. If you want to buy pullbacks, buy the high one. All right. Here's another II, a high one. You can buy above it. An attempt to reverse by the bears, outside up, you could buy above the high of that. Okay. We're starting to get flatter here. We have our first high two, a double bottom. Buy above that. Breakout, a pullback. Buy above that. In the strongest bears, you sell low one pullbacks during the initial spike down, and once the trend weakens and begins to evolve into a bear channel, look to sell more complex pullbacks like a low two, or a triangle, or a wedge bear flag. So here we have a bear spike and another spike, probably becoming always in short. A low one short, you can take that. Here we have a double top, so that's a low two short, you can sell that, and then just keep selling all the way down. Another breakout, a pullback, low one short, a breakout, a pullback, low one short. And okay, this you could argue, well, this is more complicated. The market went down and up here, so there's a low one, and then it went up again here, so this is a double top, and that makes this a low two short. And that is the end of the module on best trades.